Hello, everyone. Welcome. Want to thank you all for taking some time out of your busy schedule to spend the next 45 or so minutes together so we can talk about one of the most pressing topics, especially now and all that we have going on and all that has changed in the last year. It's more important than ever that we really grasp and understand financial education. Today's topic is financial education in the workplace. So I'm talking to those of you who have jobs, who have an income, or who have a spouse that has a job or an income. And if we've not met before, I'm going to go ahead and just introduce myself to you. My name is Jennifer Cuartas. I'm a national director here with Exertus Financial Partners. I spend a lot of time every week, every day, helping individuals, families like yourself to effectively manage every aspect of their financial lives. Okay, we're talking everything from overspending habits, reversing debt, financial decisions that weren't well planned. We've all done that. Okay. I think everybody's guilty of that. Most people don't know how to turn it back around and make it a positive. So, I'm going to talk to you about increasing some savings, even tax free retirements. If you're not where you want to be financially, I know that that can be a very overwhelming feeling. And if you don't get it under control pretty quickly, it'll start to feel like things are spinning out of control, like you can't keep up, and you're waking up every day thinking about it. You're going to bed every night thinking about it, even though you're working and you're making money and you're paying some bills without the proper wealth strategies put in place. What you're going to end up finding is that paying bills will basically be the extent of your paycheck. And you're going to be missing big opportunities in taking advantage of strategies that are already out there and available for you, just for the simple fact that you're lacking the knowledge. And it's going to create big problems later on. It's going to affect many areas of your life, right down to personal happiness, your job performance, relationships that you have. When finances are causing havoc in our personal life, it affects every piece of it eventually. So, I'm going to share with you today some strategies that have created infinite wealth for the top one percenters for more than a century of generations in our history, because knowledge is power. What I'm going to share with you today, I mentioned, is for the top one percenters. They use it all the time. They've been using it for probably since like the late 1800s, but it's not reserved for the working class. It's not reserved for people like yourself, like myself, right? Because they keep these things secret. And unless you're paying the big dollars to the big financial coaches, they aren't turning around and giving back to you. I ended up taking a completely different approach with my business, and I hold the licensing that I need to teach you about these plans. And my goal is to help the working class. So I'm going to introduce you to Jessica. She's a real client. She's a 42-year-old manager of a small company. She makes pretty good money, but like a lot of people, she's in a situation that she can't get out of. She's usually hindered because she's got debt. She's cash flow problems because of that debt. She gets a small 401k through her company, but she's very uneducated about taxes. So that's a problem for her because she doesn't know how to avoid it. Unless you've gone to school and learned about it, you probably don't realize that there's ways to avoid it. And she doesn't have the flexibility in her spending. She has trouble, um, if a big expense comes up, paying for it with cash, because instead she's grabbing for credit cards, which does what? Creates more debt. And a lot of us are in her situation. I'll go into a little bit more about her personal financial scenario towards the end. I'm actually going to show you her bills, what we were able to do for her. But before we do that, I want to share with you a recent study that was done. Guys, the results were alarming, which is why I'm sharing it with you. There were several different generational groups that were studied. What was really interesting was that the majority of the employees, regardless of what generation they were from, and I'm talking even those that are knocking on retirement's doorstep, all of them gave the same answers, which means with time, the problem doesn't change. With raises, the financial struggles don't change. Getting closer to retirement, it didn't get any better. We are used to generations where we look at our grandparents and we're like, oh, if I need to borrow a little bit, grandma's got me. Oh, if something happens to grandma, I get that inheritance, grandma's got me. Guys, one day you're going to be grandma. How close to being grandma are you? Are you a grandma? Is that your situation? See, our past generations, they looked at money a little bit differently and they looked at lifestyle a little differently. And it wasn't until much later, not that long ago, that we started relying on borrowing other people's money and asking for credit, and interest became a real big thing. So this particular study, it pointed out some real issues. So what I want you to notice is that the top answer when asked, what does financial wellness mean to you? Guys, financial wellness wasn't about the big things. It was about not stressing about finances. That was the majority of the answer, followed by being debt free, having enough savings to not worry about unexpected finances, financial freedom to be able to make choices and enjoy life. I used to make this joke. I don't feel like it's a joke anymore, but I used to make this joke when I was young and I was first in my working years. And people would say, what are you going to do on your day off? And I'd be like, oh, I'm going to clean my garage. The same thing I do on vacation. Because when I was growing up, the family used to get mad at my dad when we would do things like family reunions. And we live in South Florida, and the family reunion would be in, let's say, North Carolina. My dad's answer was always the same. I can take 2 or 3 days off of work, but I can't take 4 or 5 days off of work. And to be able to take my entire family, mom and dad and 3 kids, to North Carolina, it's going to cost me 2 weeks of my income. So I'm going to stay at home. I'm going to skip out. We're not going to go and see the family, and I'm going to clean my garage. I'm going to do something productive. And I used to joke, when I was in my younger working years, like, oh, what are you going to do this weekend? Oh, I'm going to do what I do on vacation. I'm going to clean my garage. I'm going to do something productive. It wasn't until I had children of my own and married and realizing that, gosh, that wasn't a pun. It wasn't what he wanted to do. It was because we didn't have the options, because without putting ourselves in much greater debt because of the interest that we were going to accrue on those credit cards that he was going to have to max out just to be able to go see family. He had to make a decision one way or the other. And to him, he just couldn't justify it. He couldn't justify getting himself more into debt. So prior to losing my grandmother, I didn't see her for 6 years. And I literally got to see her right before she passed away. And I live with that regret. Guys, don't make finances be your regret. Because when looking at this, and I know I'm spending a lot of time on this, but looking at this, very few respondents defined financial wellness in terms of retirement. But you guys, every day, every week that passes, every month, every 6 months, every year, you're getting that much closer to your retirement. And it should be the greatest area of focus for us not just trying to figure out how to pay our bills, but if you can't figure out how to pay your bills right now and you're part of that 34%, you're who I want to help. You are the one who needs this, because by lacking a plan, this will be the cause for an enormous problem later on in your life if it isn't already too late. You see, the three major financial problems that will happen in people's lives is that one, people pass away too soon, leaving behind debt to loved ones. The second one is, you ever met anybody before that got sick? You ever known anybody that couldn't work anymore because they became disabled? What happens if you can't make any more money because life threw you a curveball? But listen, the biggest problem, like the number one, is the one thing people don't think about, and that's outliving your money. This pandemic taught us the majority of our country is not prepared for an emergency. Okay? Going into retirement without security is one of the most dangerous mistakes that you can make, because our greatest asset is the ability to be able to work a job, make money, have income, because we have to do what? Pay bills. Well, think about it. By 65 years old, you should have 30 years of income and life expenses saved. Because what happens if you live until you're 95 years old? Think about how many of you have said, oh, my family, my grandma, she was 96. Oh man, my grandpa was 104. What happens if you run out of money and you don't have that 30 years of income to pay for all of that? It's scary. And the fact that 34% of people are worried about just paying bills, and that being a major cause of stress. Financial Matters is the top one. You see it at the very top of your screen. 59% of people of reasons for being stressed are money challenges. But what happens when you're stressed? Well, I can tell you from experience, it causes health problems. And then when you have a health concern, how do you work your job? So 15% of people, it's not even just the stress of their job itself, it's compounded stress by other things going on. Because now you're sick, now you're trying to work your way through your daily functions at your job and meet the demands. But if those health concerns cause you to miss days, now you're really in money problems, especially if you're grabbing for those credit cards. And then when you're stressed about your health, your job is starting to, kind of get on your case a little bit because you need to be there. It's affecting your bills and everything. That's when you start arguing with your spouses. You start stressing on your kids a little bit too much. And then it becomes, no, 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 I'm not going to play with you. When are you going to play with me? Later. We'll do that later. We'll do it tomorrow. When's the last time you just said, let's shut out the world and just say yes? Like we don't realize how much time goes by that we're pushing people off. And usually it's because, I'll tell you my favorite saying, not really, but something I always said. Well, actually, I'm in the middle of work right now. I can't play with you. Oh, I've got to just finish this one last thing. I'm so sorry. I'll play with you in a little bit, and then it's bedtime. You say it so often. And only 4% said it was other things that created stress in their life. But you see that this is across all different generations of people. We have to eliminate this number one concern, and that's money. And with the right education and the right plans in place, you can do that. So that brings us to the idea of retirement. I believe that you focus on things that you can control. There's a lot of things that are going to happen in your life that you don't have any control over. But the one thing that you do have control over is how much knowledge that you obtain, how much of that knowledge that you apply, and how you implement it into your life to give you a better future. When I first got into this industry and started really learning about money, um, I wasn't prepared. I I saw 6 family members pass away in 6 months in my family. And I watched my mom and dad come out of retirement. You see, they were just trying to go back and get jobs to be able to cover the lack of planning that 5 out of the 6 didn't put in place. Now, you might be asking me, why am I bringing that up when we're looking at a screen that's talking about retirement? Well, here's the thing. My father worked 36 years to get his retirement. And because the failure to plan on other people's behalf, he started having to dig into that retirement to pay bills for lifestyles of other people who had already passed on. But the truth is, 54% of employees have less than $50,000 saved for retirement. So it was a very big deal that he needed to stretch that money for as far as he could possibly stretch it, because he was the minority. He had a retirement, but looking at the amount of money that people are getting towards their retirement when they've already put in 35 and 40 years into a company, guys, it's scary. Especially think about it. If you're making $50,000 a year right now, a year, and you retire at 65 and you plan on living till you're 95 and you have less than $50,000 at the time of your retirement, you don't have excess money to start dumping out there for other family members. So then who becomes the one to take care of you? 45% of employees, they think that it's likely that they're going to need to use money from their retirement plans for other expenses. And that's what my dad had to do. And because that happened, I went into this industry 5 years ago, full force, wanting to learn everything, wanting to save people like you, like me. Because when your parents didn't make good decisions, well, they just don't know that they're teaching you incorrectly. So I didn't want that to happen. And so I want to help you to not be one of these 45%. I mean, that's almost half of everybody you know. Eventually realizes that the money set aside for retirement ends up going for expenses of something completely unrelated, which then leaves you without what? It leaves you without the ability to pay your bills. Let's remove the word retirement from this and let's call it what it is. It's life. Nearly 1 out of every 3 employees, it's about 32%, are not even taking advantage of any type of retirement options at all. So I want to put this into perspective for you. If you're 45 years old and you don't have $842,000 in your 401k, you're going to find yourself in a real scary situation one day. If you're 45, you've got 20 years to figure out your retirement. But I bet you if I look at your finances and you have a 401k, you're contributing $100 a month because your job's contributing another $100 a month. They're matching you. And you think that that's a great deal. Can you live off of $200 a month? Probably not. Can't live off of it today, and you can't live off of it then. But with 842,000 in your 401k at 45 years old, contributing $100 every month, getting it maxed and matched by your employer for the next 20 years. That's assuming that pandemics don't put your company out of business, that you're still capable to work for the next 20 years, that you do not become sick, you do not become injured in any way, you're not terminally ill, you don't pass away. I mean, life is perfect. You'd still have to contribute that money every single month for the next 20 years to have $900,000 in your account at 65 and a half when you go to convert that to your retirement. But here's what happens. You worked at the same job for 30, 40 years. They tell you that it's a tax deferred option. Pre-tax money goes in the account. You're like, that's fantastic. But no one educated you about the other end. They told you all the great stuff about today. But in the future, when you go to cash that money out, think about this logically. What happens every single year with taxes? Do they go up? Do they stay the same? Or do they go down? And feel free to type in the chat, what do you think is going to happen? So when you go to cash that money out, I'm going to tell you what's going to happen. The $900,000, and this is based on today's numbers, because like I said, I don't know how high they'll go in the next 20 years, but based on today's numbers, you're not going to have 900,000. You're going to end up with 600,000. $600,000 after taxes and fees still sounds like a lot of money until you think about the fact that you have to budget from 65 to 95 at minimum, because if you live that long or your spouse does, you got to have that money. So do the math, divide it out. That comes out to $30,000 a year or $2,500 a month. Might sound okay if you're not paying a mortgage anymore by then, but what ends up happening? People buy a mortgage when they're 45 years old, when they're 50 years old. That means they're going to be paying that mortgage until they're 75 years old, 80 years old. So a good 15 years of their retirement is going towards the same debt you've got now, right? It's not going away unless you do something different. So what are you going to do to change that? If this is your situation, I want you to take a serious look at your bills and what it costs you just to get by each month. What will retirement look like for you if you're not able to work during those years? Only using what you have available to you without having to ask for help from somebody. Is that a possibility if nothing changes? So are you, based on those questions, based on that information, are you going to have a great retirement? Or do you have some doubt? And if you're like most people, you have some doubt, because more than 80% of today's employees believe that they're going to have to work during retirement years. A third of people expect that they're never going to be able to stop working. But nobody thinks about what happens if they get sick and can't work anymore. So think about this information. You've been working for how many years? Tally it out. Did you start working when you were 14 or 15? I don't just mean in the job you're in right now. How many years total have you been working? How much money have you earned over that time? If you had started working when you were about 15 and you're 45 now, you've probably made over $1 million. Okay, that's just based off of average numbers. How much of that money is in the bank right now? How well did you manage that money? If you had a life or a death scenario right now and you had to go to the bank, put in your ATM card, pull out 100% of that money, how many years can you live on that? How big of a problem can you solve? Or how scary are things going to get? That's going to be your situation if you don't change things. So that brings us to the BYOB concept. What this stands for is be your own bank. That's what BYOB means, not any of the crazy terms that you've heard before that BYOB could mean. But BYOB by Exertis teaches people how to reverse their financial implications by becoming their own bank. So just to give you an idea, I mentioned to you a little while ago that this has been around for a long time. You just don't know about it because you were probably in the wrong social circles and you didn't have access to it. But this goes back a long time. like before Disney World, back before the Great Depression, even. Okay. So I'm going to give you a couple of examples. These are just three out of hundreds and probably more than that, examples that are out there. But these are three gentlemen that all have something in common. And it was how they utilized the cash value inside of life insurance policies to be able to fund their dreams, their current expenses and their debt, and reversing financial implications. So Walt Disney, guys, when he was trying to reach out to investors, banks, lenders, trying to get loans to finance his dream, Disney World, but not just Disneyland, Disney World, but the whole animations concept, right? I mean, look at the Disney franchise. It's extensive, but nobody would finance him like at all. Nobody would finance him. And some of you guys might have ideas. You might have inventions like in the back of your head, or maybe even that you've put on paper. You might have business ideas. You might have, goals and aspirations. And you're like, well, nobody will give me the money for it. So what do I do? Well, you do what Disney did. He had two life insurance policies, actually, that he decided to cash in, use that money to be able to finance his dream. And you see what it turned into. Ray Kroc actually had a lot of debt because he purchased McDonald's from the McDonald's brothers, and he was kind of living beyond his means because he used all of his cash flow that he had to purchase the business. And then he couldn't take a paycheck. He couldn't even afford to pay his employees, and McDonald's almost closed down. So what he ended up doing was taking the money out of two life insurance policies. They were high cash value policies. And he took the money. One went towards the Ronald McDonald idea, where he created that whole marketing campaign to put McDonald's on the map. The other policy he used to be able to just stay afloat, keep his employees paid. And then we've got John D. Rockefeller. He actually held 2% of the United States' entire money. The entire of the money that was in people's hands during around 1911. He held 2% of the entire country's wealth. And then what happened? The Great Depression. You would think that he lost all of that money. When businesses were closing and even government affiliations were shutting down, everybody was trying to figure out, what are we going to do? He actually took his money, put it into a high yielding policy that had a high cash value return with guaranteed minimums, regardless of what was happening in the world at the time. And you see what we're dealing with right now with this whole pandemic that just came out of nowhere. We have to take advantage of these types of strategies and solutions. The only industry that didn't lose any money, but actually gained money during the Great Depression was insurance. And so he figured out a way, which they called the Rockefeller method for years and years and years. It's called something else now. But he figured out how to create 6 generations of wealth for every policy that was in place, with the use of these particular IRS tax codes intertwined into it, and super high cash yielding policies. Well, that's exactly what our BYOB plan mimics. It was based around that, in conjunction with 2 other things, which I'll share with you in just a moment. So the idea is that right now we're facing a ton of debt in this country. And what do people usually think about when they try to reverse their debt? It's consolidating, which means getting another loan, putting it all onto one credit card, which means more interest, refinancing our homes, which means longer to pay back your debt. And these are just solutions that lenders came up with to keep you in that same hole. And so they're taking advantage of the fact that you're misinformed. And that's not fair to anybody. And because of that system, over 44 million Americans hold over $1.5 trillion in student loan debt, 1 trillion in credit card debt. 42 million Americans have medical bills that they can't even pay. That's going to continuously go up and up and up, especially with what we're dealing with right now, right? Americans hold $8.8 trillion in mortgage debt. You're living in properties that you don't own. And 1.2 trillion in auto loan balances. Guys, that's $14 trillion in debt for our country, just in these things that we consider to be of extreme importance and lifestyle. How much of that debt do you hold? How much are you contributing? Because guys, people don't just finance cars and houses and school loans. They're financing solar and credit card bills and vet bills and furniture and everything, computers and cell phones, and they're financing it all. I know, because before I was educated, I was doing that, but it all adds up. So what if I could teach you some strategies on how to get you out of debt, like completely reverse all those decisions you made, but still keeping all of the items, like not having to sell your car. You don't have to sell your home. You don't have to refinance. You don't have to spend more money, but get you completely out of debt in 12 years or less, inclusive of your mortgage. Guys, that's serious power. And I'm doing it for people every day because of our BYOB concept, because it merges together the idea of these high cash yielding policies in conjunction with the gentleman who's known for the infinite banking system, which is Nelson Nash, also taking bits and pieces of Dave Ramsey's concept of debt snowballing. The difference is that both of these strategies rely heavily on your savings and on how much cash flow you have access to personally, and changing your whole life, like going on a financial diet. But we all know diets don't work. That's because we all have cheat days and things like that. So by putting you on a financial diet, it doesn't make the problem go away, because your money didn't get any bigger. You still, even if you get out of debt, how are you going to finance your retirement? So do you ever feel like, every step forward takes you 2 steps backwards? You finally get a little bit of money and then something breaks. Finally get a little bit of money and you got to replace your car. Finally get a little bit of money and the hot water heater overflows. You finally get a little bit of money and something else happens. And you're playing this yin and yang all the time. You know what I mean? And so what we do is we combine these two systems together. It reduces the volume of the interest that you're paying to lenders, which, that's going to be huge for you, because that frees up money quicker. It helps you to actually improve your cash flow, allowing access to cash for all of the other things that happen in life, and funding your kids' college, and starting or expanding a business, going on vacation, retiring tax-free. But in order to do any of that, you need to understand really how banks work. I know you think, oh, it's a place where I go and I put my money and I keep it safe so people don't steal from me, right? Wrong. Banks are businesses. I bet you didn't even know before today you could actually be your own bank and it wouldn't cost you very much. Like, really, you can be your own bank without, for some people, without spending anything than what they're already budgeting for. So here's what happens. You put your money in the bank and they say thank you, because periodically, to thank you, they're going to give you 0.01% interest. So your money gets to grow, kind of. But then what they do is leverage your funds. For about every $1 you give the bank, they earn 7 by charging others 8 to 29% interest on personal loans, credit cards, car loans, all of that stuff. So to really earn anything that you're going to recognize or even notice, you've got to put a lot of money in the bank. Well, most people aren't dropping 6 figures in the bank. But just to get $10 in interest, you've got to drop 100 grand in there and let it sit there for a while and don't touch it. Don't remove it. And then when they give you that $10, you're going to get taxed on it as income. So you're going to end up with $7. That's not anything. What are you going to do with that? You're going to go buy a coffee probably, right? So our concept works completely different because we pay you like the bank. $100,000 you put into this system, you're getting a guaranteed 4%, guaranteed, like no questions asked. It's in writing. It's a contract. It's legal and binding. It's happening. So you get $4,000 in return, and it's tax free, you guys. It's tax free because of the way that it's set up. It's not a taxable account. Now, I mentioned that if you go and let's say you take that $100,000 and you take 50 of it out to expand your business or to build onto your house or what have you, are they going to still pay you that 0.01% on the 100,000? No, they're only going to pay you that interest on what you actually have physically in the bank. And I'd like to challenge you guys. I would love for you to look at your bank account statement, look at your checking, look at your savings, and see when the last time they actually gave you an interest payment was. I bet you have trouble finding it. So this type of concept, it actually functions as a non-direct recognition loan. So what that is it's a loan provision that allows you to still receive earnings at that 4% rate in the return of cash value that is accessible by you without penalties. And the amount that they're paying on is unaffected, whether or not the cash is sitting there in the account or if you took it out temporarily. So very unlike the bank. You're not going to find another loan provision that has that in it. It's very, very rare. Okay. So I want to talk to you real quickly about how mortgage loans work. And again, maybe another step that you should write down to do a little bit of research on your own mortgage loan. This is what a lot of people don't realize. You go into a mortgage, you're happy with the interest rate, you're happy with the monthly payments, so you don't go further and ask questions because a 3% or a 5% interest rate sounded really good and the mortgage amount sounded really good, right? But what you're not realizing is how much they're actually ripping you off. The first 15 years of your mortgage, you're not even really paying much on the principal, on the house itself. You're paying heavily on the interest. So look at your statement. Maybe it came in the mail, maybe you have access to it online, but what I want you to look for is something that is the breakdown of your monthly payment. So let's say your monthly payment is $1,000. A piece of that is going to go towards principal and interest. A piece of that is going to go towards your escrow. Take a look at the breakdown of the P&I or principal and interest. How many dollars are actually going to the principal balance? That's how much you actually paid for your house. And how much of that money is going into the lender's pocket as a thank you very much for doing business with me interest payment. I just helped a lady and her mortgage was $1,400. She had been paying on it for a year. And do you know that only like $250 was actually credited to her mortgage? All the rest went to interest. I mean, she had a higher interest rate, but still, I mean, that is huge, huge. And so we get caught up in this idea that we work, we put our money in the bank so that we can cut a check and pay our bills. But what are our bills usually? Outside of maybe power and water, we've got car loans and mortgages and credit cards and student loans and HELOCs and PLOCs and all of these things. And look at all these interest rates. You're like, yeah, but it's only 6% on top of 6.5%, on top of 12%, on top of 6%, on top of, on top of, on top of. Well, how many of those on top ofs can you sign up for before you're using your entire paycheck? And this is what it means that you're actually giving out the majority of your money that you're working hard for, taking time away from your family for, to try to have things in the future, and you can't get ahead because you're on this financial treadmill. Because just add them up. If you have 6% on your car and 6.5% on your house and 12% on your credit card, but you got a really good job, but you pay 6% on the student loan, guys, that's what, 12 plus 12 plus another 6, it's 18.5%. I'm sorry, 18% just in credit cards and student loans, another 12.5% just between the house that you live in and the car that you drive to get yourself to work. That's 30.5% just on those 4 items. Just on those 4. If you had nothing else. Guys, that's a lot of money. That's 34 cents on every dollar that you make. How much money do you make? So unless you change what you're doing, then you're going to keep being on that treadmill. So what we do with the BYOB method is that you'll still keep your bank, you'll still work and deposit your checks, but your cash now generates a very nice return, which you can use as collateral to pay off your debts. And we give you a full roadmap. I can tell you from the moment that we sit down and I get all of your numbers, I can tell you what your debt looks like without me. And I can tell you exact payoffs when you'll have cash that accumulates, not cash you worked for, not cash you borrowed, cash that accumulates just by redirecting your inefficient dollars that you're spending right now, already spending in your budget. So that now you have this account in place that'll be formatted around your personal situation. You'll use it like a traditional bank, except for instead of asking to borrow lines of credit, you're going to build your own line of credit for future purchases, expansion of your business, to start one, to go on vacation, enjoy life, retire, so many things you can do. You have access to it when you want it and how you want it, which is very different from your 401k, because if you try to access that money right now, they're going to really penalize you if you're younger than 59 and a half years old. And it's your money. It's your money. You worked for it. You put it in there. Why can't you use it? You know what I mean? So we don't do that to you. We already talked about the non-direct recognition loan. It's an investment strategy for you because you're gonna end up growing the money instead of working 4 times harder for it. It's gonna work 4 times harder for you, and then you're gonna have it later on as your tax-free retirement account, which is going to completely change your situation. You'll argue less about money. You're going to find wasted money that you just didn't even realize was going out the window or wherever. We're going to improve your cash flow, dramatically increase your savings, get you out of debt faster than you thought possible. You're going to learn how to monetize yourself and prioritize your accounts. And we do that with you the same way we did with Jessica and Frank. And I introduced you to Jessica at the beginning of this presentation. And I told you that she was a manager for a small company. She loves her job, but she does make about about $2,500 a month doing it. Her husband makes about $4,000 at his job. And even though they're making $6,500 between them a month, they're just barely getting by, you know what I mean? Because they don't have retirement, but they looking at their situation, they would like 5 grand. In order to make that happen, they have no options but to reduce their debt. They need to get their spending under control because, we have a lot of emotional spending that we do in life. Um, they want to send their kids to college. They got 2 kids. But in order to do that, got to increase their savings. Otherwise, they're going to be doing what with their house? Refinancing it and getting into more what? Debt. So this is their scenario. This is their situation before we ever sat down and talked. What I do is I have them fill out a form. Then I take that form and I input it into a computer system that actually will amortize their debt down, and it'll take a look at the power of the policy that I would be able to put in place for them, and it meshes them together and it spits out this roadmap. So I'm going to walk you through that. We're almost done here. This is the last little bit of what I wanted to show you, is that this is a real client, exactly what we were able to do for them, and just kind of see, if this kind of mimics your situation, and maybe, this is something that you'd like to put into place for yourself. Now, what I want to point out here is that this is their payment plan over 29.8 years. Where did I get this number at? If you look here, I've listed out all of their debts, okay? They finance their furniture. They've got a couple of loans. They've got 2 cars. They've got Care Credit. They've got PayPal. They've got 2 more credit cards here in their personal residence. Your residence, for the most part, is always going to be like the extent of your debt, right? That's your biggest purchase you're going to make until you make a bigger one for most people. So they finance everything in their life. And what I can tell from this is that some of these debts, these 2 right here, actually are in her husband's name. They're under Frank's name. And then the rest of these are actually under Jessica's name. All right. Now, you can tell the difference between the 2 of them because one has better credit than the other one's got. But that doesn't change the fact that now they have to reverse that problem, right? If we add up all of their payments here, it shows you that they're 29.8 years to still pay on this personal residence. They literally bought it like 2 months ago. So they're looking at 2050 before their bills are paid off. About 5 years for their car, 4.5, 5 years for their credit cards. I mean, they've got about 315 grand in debt. If you ask somebody, what's your debt? Usually this is the number that they'll give. So when I ask it to you, I'm sure you'll add up what you need to pay off. But here's the problem with that. Unless you're paying off all this stuff today, this number is going to keep going up and up and up and up and up and up and up. There are about $3,000 every single month just in bill debt, just to break even and not have things taken away from them. But over time, they're still looking at another $159,000 in interest on top of the interest they've already paid to these companies. So this is not their real debt. $474,000 is their real debt. Okay. So let's go to the next screen now. This information stays the same. But what changes is this. Look at the payoff time for all of these debts. The majority of the debts with my system, using the BYOB concept, has them owning their furniture, owning their 2 cars, completely lender free with all of their credit cards, their furniture finances, their pet bills in less than 3 years. Let me go back up here now. Look what it looked like before. All right. So now we're down here. We're looking at what the difference is. Look at the house. 9.75 years. You couldn't do that on your own. I didn't refinance their house. I didn't even add to their debt. I just worked with the budget they were already spending. And the truth is, they were putting a little bit of money in a savings account every month, and they had a life insurance policy that wasn't doing them justice. We replaced the life insurance policy. That's money they were already spending. I replaced it for the same amount that they were spending, but with one that earned cash, because the one that they had wasn't. It was just a term policy that was going to run out at some point. The policy I put in place for them actually will carry them till they're 121 years old, will provide for them if they ever get sick, if they ever get hurt, if they can't perform 2 out of the 6 daily functions, life shows up and they don't get to the end of this program that will help them to become free from lenders, it's all paid off anyways. That's huge. That is huge. You can't do that without this plan. So here's the overview. At year 30, in their current plan, okay, I just rounded it up 2 months. So at year 30 in their plan, if they don't change anything, they own their house, they have their cars, they have their furniture, but they have zero retirement. Their kids didn't go to college. That's going to cause more struggle. They didn't free up any money. And now, they're 60 something in debt and trying to figure out, do we still have energy and health to be able to work? But with our plan, we got them debt free in 9.7 years. Green is my plan, red is the plan that they have in place. So interest paid without me is 159 grand. With the BYOB concept, it's down to 82,000. That's a lot of money in between there. They end up with 985 grand in liquidity, but they've also got over $1 million savings and death benefit. Guys, that is a 7-figure retirement. So I can only assume at this point that you want to be like Frank and Jessica and shift your scenario, or at least look and see what it looks like for you. So what we do is we actually, we have to pre-qualify you. Here's the thing with our plan. It has nothing to do with your credit. It has nothing to do with your previous financial decisions, but it has everything to do with your age, your health, and how much finances that we need to tap into, how much we need to cover, how much debt if you pass away. If you get sick and you can't work anymore, we got to be able to provide for that. But like I said, we try to do this assessment based on it not costing you more out of your budget than what you're currently spending. So in order to see what your budget is and where there may be inefficient dollars, we have this form that we'll fill out with you. It's 4 pages, but it's really takes about 20 minutes for us to go through it with you. It doesn't take too long. And then what we do is input everything into our computer system, and then we get back to you with results. The documents that you will need to fill out the financial assessment, I do not need copies of them. So before you feel like you have a little bit of concern, like, I don't want the paperwork. I just want you to get certain numbers off of it. I do not need the name of the companies. I don't need to know whose name your account is in. I don't need to know the account numbers, but what you're going to want to know are the balances that you have. What is the interest rate that you are paying? Life insurance policies that might maybe be replaced or not. We'll take a look at it, but that's not the only reason we ask for your life insurance policy. We look at it as well because you have to make sure that you have enough income to justify if we're adding another one. Okay. Pay stubs are not something I'm going to collect from you either, but it does ask you what your current income is, what you want your retirement income to be, and it'll ask you for any type of 401ks, 403bs, or any type of investment accounts. The checking and saving statements, all I wanted you to do on there is just take a look at those interest payments that you got. Now, if you would like to do a one-on-one appointment with me, my website is at the bottom of the screen. It's Budget Sense, but spelled like money. So it's CENTS.com. And then / BYOB for Be Your Own Bank. And there will be a button on there where you'll actually be able to go right into my calendar and set up a time for us to take a look at your situation and see if we can even help you. There is no pressure in what we do. It will literally be an educational moment. You will get to have a full financial needs analysis done on your personal situation. Either you decide that you just want to take the knowledge and hold on to it, or we can put something in place for you. It's up to you. If it makes sense, we do it. If it doesn't, we don't. But you never know unless you sit down. I'm not going to charge you for this appointment. I'm going to waive any of those fees. And I'm also going to do another solid for you. And I'm actually going to give you a gift if you schedule an appointment and you show up at the time that you scheduled, because I am very busy. If you schedule a time and you show up without missing it, without rescheduling, regardless of whether or not you decide to go with the plan, I'm going to give you a special gift from me. It's actually a pretty big gift, and I'm not going to share with you what it is until you show up, but I'll tell you it's something that you will be able to enjoy on your days off with your family, creating memories. So, guys, thank you for your time. I appreciate you trusting in us with this information, and I look forward to seeing if we can help you. Guys, make it a great day. Talk to you all soon. Bye bye now.